Welcome to the Deep Dive. Today we're taking a look at something you've asked for, a clear, structured breakdown of crypto trading.
Right. We're getting into the two main ways people engage. Standard spot trading versus the, let's call it the high-octane world of perpetual futures.
And our mission here is really to cut through the noise. There's so much jargon, especially with derivatives, that can lead people into risks they just don't understand.
Exactly. We're going to make the mechanics clear. And maybe more importantly, show you just how different the risk profiles are for these two approaches.
Okay, so let's jump right in with the single biggest insight. The one thing that, if you get this, everything else makes sense.
It really all comes down to ownership. With spot trading, you are buying and owning the actual asset. You're holding Bitcoin.
Right. Whereas with perpetual futures, or Perps as everyone calls them, you don't own the coin at all.
No, you just hold a contract, a derivative, that lets you speculate on where the price is going to go up or down.
That one difference is the foundation for everything we're about to talk about.
It really is. Get that, and the rest just clicks into place.
So today we're going to unpack the key differences. We'll run through some specific numeric examples so you can see the math in action.
And then we'll leave you with a really clear, actionable pre-trade checklist to keep you well informed.
Perfect. So let's start with that foundation. Ownership and directionality. When you're spot trading, you hit buy, you know what you've done.
You've acquired the actual asset. You can withdraw that Bitcoin. You can move that Ethereum to a cold wallet. It's your property.
Your risk is that the price goes down, but you still own something tangible.
You still have the coins. But with perpetual futures, that ownership is completely gone. You're just holding a contract, a promise, really.
And not owning the asset is what gives Perps their defining feature, which is that flexibility, the directionality.
Right. If you're only a spot trader, it's kind of a one-way street. You buy, and you hope the price goes up. You only make money if it rises.
The classic buy and hold strategy.
Exactly. But this is where Perps becomes such a powerful tool, because it's a contract you can go long, betting the price will rise.
Or, and this is the game changer, you can go short. You can bet that the price is going to fall.
It completely changes the game. You can now profit from volatility in either direction, up or down. That's essential for any kind of active trading.
Okay, so if we connect that idea of non-ownership to the next piece of the puzzle, leverage. This is where the risk just, well, it explodes.
It really does. In spot trading, if you want $1,000 of Bitcoin, you need $1,000. Simple as that.
Which is pretty capital intensive.
And that's exactly why derivatives were created. Perpetual futures give you what we call amplified exposure, or leverage.
This is where you can control a huge position with just a little bit of your own capital.
Yes. Your money acts as an initial margin. It's basically collateral to secure a much larger borrowed position.
And the numbers are, I mean, they're kind of staggering. We're not talking 2x or 3x like in the stock market.
No, not at all. You see platforms offering up to 50x leverage. So you could put up, say, $1,000 of your own money.
And control a $50,000 position. I mean, that sounds incredible. So what's the immediate catch? What's the trade-off?
The trade-off is liquidation. It's a risk that just does not exist in the same way in spot trading.
Right. If I buy $1,000 of spot Bitcoin and it drops 50%, I'm down, but I still have $500 worth of Bitcoin. I haven't been forced out.
Exactly. You can just wait. But in the leveraged world, that safety net is gone.
Because you're using borrowed money.
Precisely. And the platform has to protect its loan. So if the price moves against you and your initial margin drops below a certain level, the maintenance margin.
The system just closes you out automatically.
Well, like that's liquidation. Your initial capital is gone and the trade is closed, whether you like it or not.
So it's not just a loss, it's a total wipeout of your initial stake.
That is the defining risk. With 50x leverage, the market only needs to move 2% against you for your entire margin to just vanish.
Wow. Okay, and that brings up another one of the unique mechanics here, something that confuses a lot of newcomers. The funding rate.
Yeah, this one is unique to Perps because, unlike traditional futures, they don't have an expiry date. They can, in theory, go on forever.
So there's no natural mechanism to make sure the contract price stays close to the actual spot price of Bitcoin.
Right. If everyone was betting long, the contract price could just drift way, way above the real price. So the system needs a counterweight.
The balancing act.
That's a good way to put it. The funding rate is that balancing mechanism. It's a small fee that's paid directly between traders, usually every 8 hours.
Okay, so how does that work? If I'm long and the whole market is long, who pays who?
In that case, the longs pay a small fee to the shorts. It creates an incentive for people to open short positions, which helps pull the contract price back down to the spot price.
And if the market is mostly short,
Then the shorts pay the longs.
so you could actually get paid just for holding a position if you're on the less popular side of the trade.
You can, but you have to factor that cost or that payment into your overall position. If you're holding for days, those funding payments can really add up. It's a cost a spot trader never even thinks about.
Which leads us neatly into strategy, because based on all these mechanics, you'd approach these two markets with totally different goals.
Oh, absolutely. The choice is very clear. If your goal is long-term holding, HO dealing, benefiting from passive price appreciation.
Then spot is your vehicle. You want to own the asset.
But if you're looking at short-term speculation, or you want to be really capital efficient, or you're hedging,
Then perps are the tool for the job.
and that hedging point is critical. Imagine you own a ton of Bitcoin, spot, but you think there's a short-term dip coming.
You want to sell and create a tax event.
Exactly. So you can just open a short perpetual contract to offset that potential drop. You protect your spot value without giving up ownership.
That's a great example. So spot is for accumulation, perps are for, well, active risk management and speculation.
That's the core of it.
Okay, to really make this difference concrete, we have to look at the math. The numbers make the risk profile so much clearer.
Yeah, when you see them side by side, it's pretty visceral.
So let's take example A, spot trading. You spend $100 of your own money to buy $100 worth of Bitcoin. Simple.
Okay.
If the price goes up by 5%, you've made a $5 profit. If it goes down by 5%, you have a $5 loss.
And the key insight there is that your maximum risk is capped at the $100 you put in.
Right. Now let's look at example B, a perpetual long. You use that same $100, but this time it's initial margin.
And you apply 10x leverage, so now you're not controlling a $100 position, you're controlling a $1,000 position.
10 times the exposure for the same $100. So if the price goes up that same 5%,
Well, 5% of your $1,000 position is $50.
a $50 profit. But here's the crazy part. That's a 50% return on your initial $100 capital.
50% from a 5% price move. That's the siren song of leverage. It's so incredibly efficient.
But as you said, that efficiency cuts both ways. What about the loss?
If the price moves against you by that same 5%, you've lost $50. That's half your initial margin gone, just like that.
And here's where liquidation comes back in. With 10x leverage, what happens if the market drops 10% against you?
Your $1,000 position loses $100. That loss completely eats up your $100 initial margin.
And boom, liquidation.
Your position is automatically closed. Your $100 is gone.
So let's just be super clear on this. In the spot example, a 10% drop means you're down $10 and you still own your crypto.
Yep. Whereas in the perp example, a 10% drop means you are instantly wiped out. The speed and the finality of that loss are what's so different.
Okay, so given that massive jump in risk, we have to talk about practical guidance, because trading like this without a plan isn't trading, it's just gambling.
100%. And the first mistake we see constantly is just intellectual laziness. People jump in without a plan or without even understanding the mechanics of the contract they're using.
So rule number one has to be, always have a trading plan. Do the research, understand the platform's rules before you put money down.
The second big mistake is failing to use the tools the platform gives you, like automated stop losses. People try to manage risk with their emotions.
Which is a recipe for disaster.
It never works. The rule here is mandatory. You must preset your stop loss and take profit orders. Decide your maximum pain point and your target game before you enter the trade.
Take the emotion out of it.
Completely. And the third mistake is maybe the most human one: over-leveraging. Using money you simply cannot afford to lose.
This might be the hardest rule to follow, but it's the most important. Only trade with risk capital.
If losing that money would change your life, it does not belong in a leveraged trade, period.
So to help you enforce all this, let's run through a checklist. A 5-item pre-trade checklist you should use every single time.
Okay, item 1, asset selection. Are you trading something stable like Bitcoin or a highly volatile altcoin? Your strategy has to change based on that.
Item 2, direction. Are you long or are you short? You have to have a clear thesis based on your own analysis.
Item 3, leverage level. Decide your multiplier 5x, 10x, whatever, and know exactly what percentage move will liquidate you. Internalize that risk.
Item 4, risk controls. Have you actually set your stop loss and take profit price points? Don't click confirm until you have.
And finally, item 5, just for perks. The funding check. What's the current funding rate? If you're going to pay a high rate, you need to factor that into your potential profit and loss.
Following these rules, logging your trades, that's what separates a disciplined trader from someone just, clicking buttons.
It's all about consistency and removing emotional decisions from the process.
So if we pull back to the big picture, the choice for you really comes down to a simple question.
Do you want asset ownership and passive long-term exposure? If so, spot is your tool.
Or are you looking for capital efficiency, high-risk speculation, and the ability to hedge your portfolio?
Then you're looking at perpetual futures. They are fundamentally different tools for fundamentally different jobs.
And the final lesson is always the same.
Yeah.
The more leverage you use, the more disciplined your plan and your risk controls have to be.
So we'll leave you with a final thought to chew on. Considering that funding rate mechanism, this fee being exchanged between thousands of traders every 8 hours.
Yeah.
How does the collective behavior of all those leveraged traders, all those hopes and fears expressed through that fee, actually influence the short-term price and sentiment of the underlying spot asset itself?
A fascinating feedback loop between the paper market and the real thing. Something to think about on your next deep dive.
We'll see you next time.